For those of you who thought mortgage rates would just continue to climb in perpetuity and climb into 2024, you want to listen to this episode because we're just coming off of the month of November 2023, and that was the best month for mortgage rates in the last 40 years. And there's a lot going on in the markets that are influencing that. My name is Jeff Smith, CEO and loan officer of Tiger Home Loans. I've been in the mortgage business for 17 years, and as a mortgage broker, that gives me the ability to offer the lowest rates in the industry, which we have here at Tiger Home Loans. And so I'm dedicated to helping my clients secure the best rate, have the best experience, and most importantly, get the product that fits their needs the most. And so today, I'd like to talk to you about interest rates and what's going on. So we had November, best month we've had for rates in 40 years. We saw a significant improvement in mortgage rates during the month of November. Rates were down over 1%, about 1.25% over that 30-day span. And so, when we look at rates in a bigger picture view, mortgage rates historically track inflation. And so when we rewind back to the end of COVID and the end of the Fed pumping low rates and easy monetary policy into the economy, and we started to see rates rise, what happened at that time was inflation had gotten out of hand. Inflation increased significantly after 2 years of basically free money in the economy, with the government printing a ton of money to provide COVID relief programs, COVID compensation and income replacement, low interest rates that were effectively 0% rates. All of that really juiced up the economy. And then with the economy juiced up, it ramped up inflation. And so then as inflation started to increase, the Fed pivoted very quickly and they started hiking rates. And so mortgage rates, as inflation started rising, mortgage rates started rising, because mortgages turn into long-term bonds, and long-term bonds are most heavily influenced by inflation and what the expectation of inflation is for the near term. So as we got toward the end of this cycle, mortgage rates start rising, the Fed starts increasing rates to try to slow down the economy. We saw mortgage rates tracking inflation, and inflation got over 10%, by some of the metrics that you can look at. And then the Fed was hiking rates not to increase mortgage rates, but they were hiking rates to increase other rates throughout the economy, which then slows down the economy. And so a slower economy would have less inflation, and that would help to bring mortgage rates down in a normal scenario. But what we saw take place was that the government had borrowed so much money. The money supply was significantly increased. And when the government borrows money, they have to do it by issuing debt. So they sell bonds, treasury bills, which are bonds. And those bonds are a form of debt to the U.S. government. That's how they get money to finance the operations of the government. So as the government added more supply of debt to the markets, that put a lot of pressure on rates to move higher, and specifically bond rates, and then indirectly mortgage rates. And so even though inflation started coming down last year, and we've seen a significant improvement in inflation last year from really like June of last year all the way through to June of this year, inflation was down more than 50%. So it was a humongous increase. Now, from June of last year to June of this year, we didn't see an improvement in mortgage rates, and actually mortgage rates were higher June this year than they were June last year. So what was going on with that? Well, you had the economy, which has remained really relatively strong throughout this year and last year, in the face of all of these Fed rate hikes, which was a historic run of Fed rate hikes. That normally would really tank the economy pretty quickly. But the money supply was so enlarged so much, it grew by 40% during COVID. And all of these loans were given out. All of these COVID relief checks were given out. Student loans were deferred. Money was very easy to come by. And then people's wages were increasing. So the economy was really resilient to all these Fed rate hikes. And so especially this year, even though the Fed funds rate was increased significantly. Mortgage rates were over 7%. Borrowing costs, even on credit cards and auto loans and everything, was really high. The economy has continued to stay strong for the first 3 quarters of this year. So strong economy and growth is inflationary. And so that was one area that was keeping rates from coming down. More hedge fund managers were placing bets that they believed that bond rates would continue to move higher. So they had short positions for bonds to move higher. So as Wall Street places more of those bets, that puts pressure on rates for bonds to move higher. And mortgage rates, mortgages are bonds. So that directly impacts mortgage rates. You had the Fed continuing to hike rates this year. Their last rate hike was in July. And then you've got this humongous amount of debt that the government is continuing to rack up. So here we are, a couple years removed from all of the COVID policies, and we're running record deficits. And so the government is having to issue more and more debt to finance the operations of the government. So all of that was putting a lot of pressure on rates to stay elevated and then actually even increase as we got further into this year. And so getting into the fall, mortgage rates were into the low 8s. At the end of October. And so that was really surprising for everyone. But what happened around the end of October was a couple of things. We had a couple months where we were getting less than stellar economic data. And so the data was starting to come out showing that the economy is really slowing down. Inflation is continuing to come down. We had the outbreak of the Israeli-Hamas conflict, which anytime you have a major geopolitical event like that, that's a destabilizing event. It creates a lot of uncertainty, and uncertainty is good for bonds. Investors want to put their money into safe haven trades, which are bonds. And so bonds generally benefit during periods of uncertainty, which would bring mortgage rates down. So we normally see mortgage rates go down in a bad economy. So that moved investors into bonds. A lot of those hedge fund managers who've been placing short positions on the 10-year Treasury market and other Treasury notes have said that they thought 5% on the 10-year Treasury note was going to be the peak for this cycle. And so it hit 5.01% right around the beginning of November. And then it backed up from there. It actually, at that time, when it hit 5.01, that was the peak. And then that was the beginning of a huge landslide of decreasing rates. So we've had that. We've got now more data coming out showing that Q4, it looks like it'll be really slow for the U.S. economy. Jobs numbers are weakening significantly. And the Fed appears to have finished their rate hike cycle. So their last rate hike was in July. The expectation is that they're not going to hike again. They have their next meeting December 12th and 13th here this month in 2 weeks. And there's almost zero chance that they hike rates at that meeting. And the expectation is that we'll see 4 Fed rate cuts in 2024. So that's a big change in policy from the Fed in the second half of this year. And so between that, inflation numbers that are continuing to come down, we're seeing a significant improvement in mortgage rates. And that run is continuing. Like November was the best improvement for mortgage rates in a single month in 40 years. This is the first day of December. Rates are improving again today. So there's a lot of steam behind this improvement in mortgage rates. And so here's another thing that happens with all of this. When mortgage rates are rising, lenders will tend to price very conservatively because if rates are rising at a rapid pace and they're closing loans that are at lower rates than what current market rates are, that's less profitable for lenders. And so they want to price conservatively to make sure that they don't get caught in a position with rates that are too low. But then the opposite can happen when rates start to come down. So as rates start to come down, and there's a strong trend in place, which we've got right now, that allows lenders to price more aggressively because there's not as much risk for rates turning around and moving higher really quickly in a 30-day period. So not only has the market improved significantly, but lenders are in a position where they can price more aggressively as well. So we've got all of that working together. And I think that this time around, it took a long time for the Fed rate hikes to really sink their teeth into the economy. Normally, we would see a faster reaction from the economy to significantly increased rates like we've had over the last couple of years. But what's different about this time was the money supply increasing by 40% during COVID. That was a historic increase in money. And so most consumers were in a position to weather some slower economic times. And those slower economic times come when the Fed hikes rates. So it's just taken a lot longer for these Fed rate hikes to sink their teeth into the economy and grab hold. So are rates going back down to 3%? I don't think so, barring any unforeseen event, which is always a possibility. Anytime rates go down really low, it's always something unexpected. That's what brings rates way down. When we saw rates sub 3%, that was due to COVID, which was a shock to the world. Nobody expected it. It came out of left field, and then governments were reacting, and it causes panic. So those are the types of events that give us significant relief in rates. You can't predict when those are going to happen. But I do think that we're going to continue to see improvement in mortgage rates, especially if the Fed cuts rates 4 times in 2024. Even though Fed rate hikes and cuts don't directly impact mortgage rates, when all other rates in the economy are coming down, then mortgage rates will tend to come down along with it. So there is an indirect influence with what the Fed does and what we see with mortgage rates. So this is a great time to be in the mortgage business, to get into the mortgage business, or to retool your business, because I think we're going to see an increase in business in 2024, probably a significant increase in business. And it's a great time to look at buying a home, because I can tell you, if mortgage rates continue to come down in a significant way, the home buying market is going to be a lot more competitive. Mortgage rates drive demand for home purchases. And so the real estate market will slow down when rates go up because there's not as many home buyers. And then it will heat up when rates go down because it incentivizes more buyers to come into the marketplace because they can get the same $500,000 home for $500 a month less. So you want to get ahead of that as a buyer. And the reason is, if you buy now, and you get a 7% rate, and then rates go down to 5.5% throughout the year in 2024, you can just refinance the mortgage and get a 5.5% rate, but you locked in the price before the market took off. So that's how you can hedge yourself. You can always refinance to a lower rate when rates come down. DM me if you have any questions. This is some interesting stuff that we have going on in the market right now. Hope you have a great rest of your day.